Good morning. It is Sunday, June 15th, 2025. This is Rob Sin at CEO Technician on X, at Goldfinger on CEO.ca, and you're watching Goldfinger Capital on YouTube. So in this video, we're focusing on the macro, gold, oil, precious metals, and miners. Starting with the topical news, the conflict between Israel and Iran started Thursday evening, and it has escalated quite clearly over the weekend. Isn't it interesting how in modern day, the last few years, war happens on the weekends? Obviously they started it Thursday night, but quickly went into the weekend. And there are some signs. It's still early to say, it's still Sunday, but we're getting into Sunday evening over in the Middle East. And there are some signs that this will start to potentially calm down by Monday, I believe. Based upon all the accounts I see, it seems that Israel has drastically weakened, Iran's capability of firing missiles, and its air force has been pretty much torched. So Israel has full air superiority, and they're targeting all the launchers for the missiles that have hit Israel. And I think that Iran is starting to run low, both in terms of personnel and equipment. So we'll see. There could be some surprises from both sides still to come, no doubt about it. One of the surprises is obviously the Strait of Hormuz. So this has been, people have been talking about the Strait of Hormuz since 2004. So literally we're talking 20 years. As far as I can recall, there has been discussion of, well, Iran could close the Strait of Hormuz. And why is the Strait of Hormuz important? Well, you can see quite clearly on this map. It's a major transport corridor. It's a choke point. And if you wanted to destroy global shipping and raise the oil price, you would attack these three key choke points, right? All in the Middle East. Strait of Hormuz is the most important one. So 30% of the world's seaborne oil trade goes through here. You can see, here's Iraq, here's Saudi Arabia, here's Oman, UAE, and Iran, right? So all big oil producing countries. Oh, and Kuwait. It's so small, I almost missed it. Another big oil producer, right? So, yeah, it's important. But it is literally, for Iran, it is the country's lungs. Not just oil, but all kinds of goods, including agriculture, right, goes through here. So if this gets shut down, the country of Iran plunges into an economic depression. Like, there's no sugarcoating it, depression. So would they do that? Maybe short term to cause a real crisis, but the consequences and how that would play out is very unpredictable, and it could certainly accelerate the fall of the Ayatollah, right, and bring in a new regime to the country. So we'll see. I don't think there are any real experts on this, but based upon everything I understand and how this has played out, this has been calculated for many months by Israel, probably by the US too, quite frankly. And they're prepared for different possibilities to unfold here. But it seems to me that this was very well calculated. And they sort of realized that within 72 hours, they could deal a very heavy blow to the regime and potentially start to bring about a regime change in Iran. We'll see. It'll be interesting to see how futures open in 6 hours, right? It'll be very interesting to see how that happens. Most likely, Trump has some positive headlines up his sleeve to throw out there via Twitter or Truth Social to try to stem the bleeding. It would be hard to imagine that equity futures do not open lower at this point. But again, the situation is fluid. It would also be hard to conceive that oil futures do not open higher. But again, it's a fluid situation. Actually, the fact that the S&P was only down 1.12% on Friday is pretty remarkable when you consider that, you know, the potential for this conflict to spiral into like a World War III type of thing is very real. The market was relatively numb to it. And even with oil, yeah, it was up. It was up big, but you know, $73 a barrel on WTI when you have, you know, Israeli warplanes bombing, you know, Iranian targets across the country, including, you know, refineries and natural gas, wells, et cetera, et cetera. Lots of infrastructure across the country has been targeted. That is a very minor, calm minus 1.12% day in the S&P 500. We'll have to see how this week plays out, especially early in the week, Monday and Tuesday. But I was relatively impressed by how well the market held up. JP Morgan out over the weekend saying there's a 17% probability of the worst case outcome here, an oil price spike to 120 plus per barrel. And that is having to do again with the closure of the Strait of Hormuz, right? So you know, if Iran does that, it could bring about a major oil price spike because suddenly you've got like 20% of the world's oil going offline overnight, and that is impossible to replace. Just, you know, Iran itself can be replaced. They only export like 2 million barrels a day. It's important, but it's not catastrophic if that goes offline, right? But if all of these countries and all the oil that flows through here goes offline, that's a very big deal, right? So it's much more likely that the Strait of Hormuz does not get closed. Maybe if, you know, the regime stays in power through this, there will be sanctions and all their oil will go off the global market. But again, that's difficult too because a lot of the Iranian oil goes to China. So is China going to allow that to happen, right? It gets complicated pretty fast here. I think that a lot of what has happened here is about a, you know, regime change move. The fact that they have bombed some of the infrastructure for oil and natural gas inside the country, not the Karg Island and all the stuff that has to do with the exports, but inside the country. It looks like Israel is trying to cause an economic crisis in Iran that would more likely accelerate the removal of the Ayatollah and the regime, right? So we'll see. That is sure to be a very messy process. But again, markets were relatively calm on Friday, so we'll have to see. I don't have a prediction for how this plays out. Okay, so turning bigger picture, you know, a topic that I don't hear much about is the U.S. housing market. 15 million homes in the U.S. sit vacant. That is a mind-boggling number when you think about that. 15 million homes. And think about how many people in the U.S. are homeless. And then there's 15 million homes that are vacant. An additional 3.3 million are only used part-time. There's a mountain of supply for sale, especially in states like Florida, Texas, Arizona, you know, the Sun Belt, the states. I know in Broward County and Dade County, South Florida, the supply for sale has never been larger than it is today. A lot of that has to do with just the fact that there's a condo crisis, and that's a whole nother ball of wax I'm not going to get into, but people want out of their condos for very good reasons. But anyway, there's a huge deluge of supply, and we're starting to see sellers drop prices because buyers are just not, they can't afford it. There are people that want to buy a home in this country. There's many of them. But with 30-year fixed rates above 7%, prices at all-time highs still, and the average income just not keeping up with the inflation of the last 5 years, there's a problem. There's a mismatch. The buyers they just can't afford it. So the only solution to this, well, there's a few solutions, but the mortgage rates have to come down. That's number one. But how do you engineer that? The Fed can do its best, but that creates a whole bunch of other side effects. If the Fed were to just cut like 150 basis points in 6 months, well, maybe that would generate inflation elsewhere. We've also seen when the Fed cuts at the short end, the long end yields can often rise, not fall, right? So it's complicated. So it's going to have to be an operation that's orchestrated between the Fed and the Treasury. Maybe the Treasury does a bit of a twist where they do all the issuance at the front end of the curve, and then they do buybacks at the 10-year plus long end of the curve, right? It gets a little complicated, but this is a tricky situation. This is a very tricky situation. But the simplest one is that housing prices have to fall, right? That's the market has to clear. And when there's no volume, the transactions are drying up, and there's a lot of vacancies, you're going to have to lower sale prices to clear the market for sellers to come and meet buyers at a level. And that's the reality of it. But nobody wants house prices to fall, right? Like the real estate lobby is basically the biggest lobby in the US. A lot of people are homeowners. A lot of people have large amount of their wealth in real estate. Nobody wants to see housing prices fall. But the reality of the situation is I don't see how they don't here over the next 12 to 24 months. I just don't see it. Also, toss in the baby boomers, right? Like the average baby boomers now in their 70s, some are in their 80s. Over the next decade, a lot of them are going to die. Sorry, it's just the way it is, right? And their children are going to inherit their homes. And their children, well, do they want to live in their parents' old home? Most likely they'll just cash out, they'll sell it. So this is a real mess that's brewing here in the US, among many other messes, right? Also, the debt, right? So this is from Bank of America. I mean, this just kind of sums it up, right? This is just based upon the CBO, the Congressional Budget Office. This is their projections, which, by the way, are usually wrong and underestimated. So, but they say 59 trillion national debt, public debt outstanding by 2035, right? So that is a 23 trillion increase from today, right? So that's like a 60% plus jump over the next decade that's anticipated, right? That is a major looming problem. Another reason why the Fed and Treasury have to somehow orchestrate lower interest rates, lower debt service payments on Treasury debt, right? So there's a lot of factors that all point to the same thing, that interest rates have to drop. The Fed is way too tight at 4.5% right now, just way too tight. And I know they've been on hold because of tariffs, but Trump's going to fold on the tariffs. He's going to have to. They're creating a lot of problems. And another example of that is just looking at transport stocks like FedEx and UPS, Dow Jones Services Index. Look at this chart. I mean, this is a bear market chart, right? Here's where the tariffs, become a big conversation at the end of January, early February. And then here's where they become an even bigger part in early April. We've got a very weak dead cat bounce here. Again, this index, the components of it are stocks like UPS and FedEx, right? So just people are not shipping as much. Trade has dried up a bit here in mid 2025, and we're seeing it. If you actually look down, drill down into the market, not just looking at the Mag 7 or the biggest 10 or 20 stocks that sort of drive that, the S&P and to the Dow to some extent, there's a lot of damage underneath the surface of the US stock market. This is the IWM small cap. So this was a breakout, but then the end of last week happened. Let's really watch this chart this week, how this plays out, because if this is a failed breakout, this is going to be a big problem for stocks across the board. So let's really watch this. Look at that volume on Friday. We've also got the Russell rebalance. in 2 weeks. That's usually positive for small caps, but we'll just have to see. S&P, it's looking like it's starting to get close to a sell signal here. How far does it drop? I mean, a natural downside target is 575 on the SPY. So what is that? 4 to 5% lower? That's standard stuff, right? A standard a pullback in the context of a bull market. Yeah. Save that. Talked about IWM, Dow Services Index, ARKK. So this is a monthly chart, and like the ARKK, ETF is essentially like the highest risk, highest beta stocks. Yeah, there's Tesla in here. There's other stuff like Coinbase, like maybe Shopify, I think. But this was the trade in 2020. Like this was the degen crackpot YOLO. I'm going to sit at home during the pandemic and gamble on stocks, buy calls on ARKK. Right, this stock went from 32 to 157 in less than a year, right? But then 2022 came along, the Fed, Powell got tough, aggressively raised rates, and all of a sudden, these stocks with no earnings or very low earnings and very high multiples got crushed and actually made a lower low below the 2020 COVID crash low, a lower low in Q4 2022. Since then, yeah, it's more than doubled, but looking at the slope of this ascent, just basic TA here, this looks like nothing more than a bear market rally. This looks like a dead cat bounce here. Could it go up a little more? Maybe. I mean, Trump's going to try to do everything he can to juice the market, to lower rates, to try to jack up growth. Will it work? It remains to be seen, right? But just looking at this from a TA perspective, this is as dead cat gets. But again, this is a monthly chart, right? This is a monthly chart. So we're talking way big picture here, long-term stuff. This could continue to grind higher, marginally higher in 2025, and then it could roll over and die again in 2026 or 2027. But just looking at this was a bubble. This was a tremendous bubble that was formed by 2021, and the bubble popped when the Fed had to get inflation under control in 2022 and 2023, right? Oil, pretty messy. And it does look like, again, this was a bubble high in 2008. It got popped by the global financial crisis. It's continued to make lower highs. It's never been able to regain that 2008 high since. Generally speaking, I am not bullish on oil here, even with what's happening in the Middle East. Yeah, it could rally to 80. It might even go to 85. I don't think that 120 outcome is likely at all. It's possible, but it's very, very low probability. It's much less than 17%, in my opinion. And, conflict and the potential terrorism that could arise from this could slow global travel. It could slow the global economy. It could slow oil consumption globally. This is very unpredictable, in my opinion. So I think rallies more likely to be sold here. In the short term, anything can happen. This is a monthly chart, but if oil does get back up above 80, it's probably a sell, and it's very likely to roll over and retest the lows later in the year, in my opinion. So let's turn to gold, right? A lot of you watch me for gold, for precious metals, for mining stocks. So we all know the global bull market is underpinned by looming financial repression. So that's just like the Fed is going to cut 150 or 200 basis points, and inflation is still going to be sticky near 3 or 3.5%. That's financial repression. De-dollarization, we all know about that. It's happening. It continues to happen. China's been the leader in that de-dollarization, the diversification of their reserves into gold out of various fiats, including the dollar. And just now the question of, is the U.S. Treasury, the 10-year Treasury note, is that a risk-free asset? Is that really where we're going to park all the cash that's swashing and swishing around the globe. No, a little trickle is turning into a bigger trickle, is turning into a pour out of US Treasury assets, right? And gold is becoming more and more the premier risk-free asset. So looking at this chart, the cup and handle, the most beautiful cup and handle in the history of financial markets, in my opinion, continues to play out. Trends continue to trend higher. Check out my blog post on the implementation of technical analysis, context, and probabilities, not crystal balls. This is on my Substack. I published it last week. And I talk about how, when this, like, for example, this cup and handle, when it broke out, did I know for certain gold was going to 3,500? Absolutely not. Nobody did. But when we analyze and get the gravity, the weight of this pattern, that this is a more than 10-year pattern that formed. Really, it's like a 15-year chart pattern. And it resolved very powerfully in early 2024. That was as strong a buy signal as you're going to get in the chart. You don't know the timing and the exact path of price, but it was a breakout from a multi-year consolidation. The handle of the cup and handle, and then it's just up to the trader to, can you ride the trend? Can you hang on, right? And that's a whole nother topic, but this has worked beautifully. Now the question becomes, a lot of people are asking, is it too overbought? Is the monthly relative strength index at 86.8, is this too overbought? Is this gone too far, right? And again, we don't know. Everything is probabilistic. Nothing is perfect. We can't know the future. Other people will look at the Keltner channel and they'll say it's been getting more and more outside of the Keltner channel, proving it's more and more overbought. And usually when that happens, like in 2011, you could say 2020, a correction was imminent, right? Possible, definitely possible. But remember, this is a monthly chart. So even if gold were to come back into the Keltner channel and drop to, let's say, 3,100 or even 3,000, would that be the end of this bull market? And look at how long this bull market has been playing out, right? Decades. No, it wouldn't be. It would be a correction. It'd be a shorter term correction, but it would not be the end of the bull market. And when bull markets really assert themselves, the strongest bull markets like Bitcoin in 2017 or Bitcoin in 2020 and 2021, look at how high the monthly relative strength index can rise. It can rise above 90. And oftentimes it can just sort of work itself off by largely going sideways. Okay, so you could definitely make a case that gold is getting a little frothy, a little overbought here in the summer of 2025. More and more people are becoming bullish on gold. I don't see a screaming sell signpost yet, but I'm sure it's coming because bull market has to climb a wall of worry. It cannot just go vertical on a straight line. So, in the short term, gold could absolutely pull back again, maybe as far as 3,000. But longer term, we have to really grasp the power of this bull market breakout, and that this is a secular breakout being driven by major structural forces that are only becoming more compelling in gold's favor. And again, check out my Substack. This was 8 days ago. Deja vu to 1979. And we have to study the past to help get some guide to understand the future just a little bit better. What killed that gold bull market in January 1980? Well, it was Volcker raising interest rates aggressively, 11% to 15%, and then from 15% to 20% by early 1981, right? So by raising the price of money so high, he crushed inflation and in the process made gold, zero yielding gold, much less attractive to investors and speculators, right? When inflation was rising and the geopolitics was the geopolitical backdrop was becoming increasingly out of control, gold kept rising. Soviet invasion of Afghanistan was at the end of 79. Gold went higher for another, 7 or 8 weeks after that. And then it crashed, right? Maybe you could say there's some parallels now with what's going on in the Middle East. Like maybe we were getting to the end of the bull market. I don't think so, because I don't think that bombing of Iran is the main driver of the bull market. The US debt and deficit situation, the loss of prestige of US treasuries as risk-free assets, de-dollarization that continues apace, China becoming a world power and increasingly being the price setter of gold. Those are the drivers of the gold bull market, not Iran, not Israel, right? And so what was able to crush gold in the early 80s was the Fed being super tight and the economy going into a recession, a pretty bad one. So are we going to do that again? Is the Treasury, is the Congress going to cut spending? Are we going to cut our deficits in half? Is the Fed going to tighten further? How likely are those outcomes? Because, I mean, yeah, if the Fed raise interest rates again and the fiscal situation started to get better, spending dropped, that would be gold negative. There's no question about it. How likely are those outcomes, right? And those are the questions that we need to ask ourselves. And I don't think they're very likely at this point. Gold miners. Oh, and I'll skip ahead, right? So the fact that this housing crisis is looming, it's becoming really more pronounced, more prominent. It's more likely to turn into a crisis level than it has in many years. Throw in the sovereign debt issue, the debt and deficit quagmire. The Fed is going to have to turn dovish. I don't see a scenario, especially with this president appointing his hand-picked Fed chair in 2026. I don't see a scenario in which the Fed doesn't turn dovish very soon. So that will ensure the US dollar continues to soften, and there will be more capital flows, capital flight into hard assets like metals, like gold. So now we talk about gold miners. And so I put up the Cameco chart. It's not a gold miner, it's a uranium company. A nuclear energy company is better said. And this is how a bull market works. This is a wall of worry. Look at how this has been such a finicky stair-step rally in Cameco since that bear market bottom in March 2020. But this is how a bull market works. This is called climbing a wall of worry. From $5 a share to 66. Oh, 66.66. I didn't even notice that. 66.66 close on the NYSE on Friday. That's more than a 10x, guys. But look at how the stair-step has happened. Climbing a wall of worry. We were just talking back in March and April about how the uranium sector was in a bear market. Ha ha ha, that didn't last long. So this is what a bull market looks like. It's got to climb a wall of worry. So are the gold miners in a bull market? Yeah, look at Agnico, AEM, the number 2 or number 3 gold producer globally. Breakout, bull market breakout, new 52-week highs, new multi-year highs, new all-time highs. That's a bull market by definition. Prices rising and making new highs. Is it climbing a wall of worry? Well, I would say yes. I mean, it wasn't too long ago that people were pretty negative on the big gold producers. We just have to think back to the end of 2024. The end of 2024, the sentiment was bearish on gold miners. So we're 5 or 6 months into a gold miner bull market, right? That's it. Yeah, there's going to be pullbacks. I assure you there will be a down month in gold mining sector at some point in the near future. Will it be next month? Will it be August or September? I don't know, but I can assure you there will be a down month. The wall of worry will rise again, no question about it. But look at this breakout from basically, what was this, like a 15-year going nowhere pattern? So put that into perspective. Like, it wasn't long ago, it was just last year, that AEM was at the same price level it was at in 2007. So Agnico breaking out 5 months into a breakout that took more than a decade to materialize. Newmont, this is not even at a new high yet, so we can't even call it a breakout. Already I hear people saying, oh, Newmont's overbought, Agnico's overbought. I mean, look at this is a monthly chart going back 20 years, but this is not overbought at all on any real time frame. Yeah, like maybe on the hourly or something, but what people tend to do is they micromanage and they miss the forest for a single tree or a couple of trees. They miss the big picture, right? So the big picture is the bull market in gold mining stocks has just begun in 2025. It has just begun. These stocks were flat on their ass and widely hated as recently as just last year, as recently as just 2024. Literally go back and check sentiment gauges on gold miners in November and December of 2024 and tell me what you find. So the bull market is not coming to an end in June 2025. It's just getting started. Just getting started. Wesdome, again, another beauty. This is a mid-tier gold producer. Breakout. It took a test in 2020, a retest in 2022, a retest in 2024. Fourth time was a charm for Wesdome to really decisively break through the $15 resistance level. And this is not extreme overbought yet. Okay, yeah, it's 78 on the monthly RSI. This can go above 80, it can go above 85, it could even reach 90 in a really powerful bull market move. Will these stocks have corrections in the short term? They always do. It can be down 1 month, it can be down for a few weeks. Of course it can, but big picture, we're looking big picture here and understanding the power of these secular trends and where we are in the context of history. And then I'm giving you a little gift here, Anglogold Ashanti. So this company has long been South African, and they moved their global headquarters to Colorado. So now they can be included in all these US indices. They fled South Africa finally. Obviously, they have big gold assets, gold deposits in the Walker Lane Trend, Merlin, and Silicon. So they moved their headquarters to Colorado. So now they're going to be in the Russell 1000. They might be in the Russell 2000. The Russell indices are a little weird. I think they'll be in the Russell 3000, which includes the Russell 1000. So all the indexers have to buy Anglogold Ashanti. They've started buying it quite clearly. Look at the volume acceleration here on this move. This is a breakout move. This could have further to go here over the next couple weeks in AU on the NYSE. And then digging down into slightly more obscure metals like platinum. Wow, look at what happened. What has happened in platinum here in the last few weeks. This looks like a breakout. Obviously, there's going to be some supply around 1300 after platinum has been entrenched in this trading range for the last 4 or 5 years. So we're going to have to climb a wall of worry on platinum. Suddenly, sentiment has become more favorable towards platinum. I've read more and more bullish articles on platinum in the last couple of weeks. So we got to climb a wall of worry here. It'd be natural to see some fits and starts here, but this does look like the genuine article, a breakout, a long-term breakout from a multi-year consolidation platinum. And then Sibanye-Stillwater, one of the worst miners in the world, but they produce platinum and palladium along with gold, and so they're catching a bear market rally. But make no mistake, this is not a well-run company. This is not a good mining company. So buy it at your own peril. It is a proxy play on platinum, and suckers and gamblers will buy this to speculate on a rising platinum or palladium price. but just understand it's a trading sardine and it has an expiration date on it, in my opinion. Silver. So this is another one. Silver reached 36.89 last week. It's overbought. It's overbought. It's not, guys. Like, yeah, it might be overbought on like the hourly, like I said, but it's not overbought. This is just getting started. The monthly chart shows just how early this is. Okay, like talk to me at like 40 or 45. Don't talk to me at 36.30. Okay, the rate of change is just turning up. The monthly RSI is not even at 70. Silver has been climbing a wall of worry since 2020, with lots of fits and starts along the way, lots of bearishness and lots of supply coming in and selling it down at various times. It's just breaking free from its chains. And we're seeing silver juniors like Vizsla break free from its chains. I mean, look at this chart. It had its, big rise in 2020 and 2021 when Panuco was a new discovery and they were finding more ore zones across the property package in Mexico. And then obviously it fell along with the junior mining sector in 2022 and 2023. And it put together a pretty powerful bottoming pattern there during those tough years, right? Like the seeds of the bull market are planted during the bearish years. 2022 and 2023 were bear market years for the junior mining sector, for the silver mining sector. And now is just breaking free, breaking out to new all-time highs here in June of 2025. And then the final chart, TSX Venture, again, not a perfect proxy for the junior mining sector, but good enough for our purposes. You can also look at the GOEX ETF to get a better gauge of the gold juniors. But it's a pretty good proxy on small cap and micro cap Canadian stocks. And what do we know about micro cap venture capital companies? Well, they tend to do better during low and falling interest rate environments when central banks are easier. There's easier money. The price of money is cheaper. We saw that in 2020 and 2021, this incredible ascent, this incredible bull market move. But then we saw the flip side of it throughout 2022 and 2023 when central banks tightened policy and the price of money went way up and financial conditions tightened, right? Well, now look at what's happening. The TSX Venture is breaking out. There's a bit of a head and shoulders bottom here that you can draw. It has broken the neckline of the head and shoulders bottom pattern. It's not quite at the resistance level yet. I think we can get to 800, maybe even to 850 on this move. And then the inevitable correction will come, right? But for now, this does look like a rising tide. And this does look to me like investors and speculators are starting to price in the Fed having to cut, right? And then we go back to the talking points and just why the Fed is so trapped here. The US housing crisis, this stealth housing crisis with this overwhelming supply on the market and shadow, housing inventory, and then the baby boomers dying off over the next decade or so, and all that supply coming into the market, and then the fact that the U.S. government debt situation is, we can confirm it's past the point of no return. Just the interest on the Treasury debt at this point is pretty overwhelming. So the Fed and the Treasury are going to have to pull out a magic trick here over the next couple of years. And maybe that will be a risk-on environment for microcap, small cap, venture stocks like the ones that reside on the Canadian TSX Venture Exchange. And that is it for me this weekend. Have a powerful, safe week, and may peace prevail.